Welcome to the Daily Update, where I'll go over the action in the market for Thursday, September 14th, and then we'll see how things are looking for Friday, September 15th. We had a pretty significant up day. There was some nice movement in the price of the S&P 500. There's some kind of underlying weakness that I'll point out, and we are improving technically. Unfortunately, we're starting to come into a weak seasonal time with the market. And again, that's based on what has historically happened. Doesn't necessarily mean it's going to happen that way this time, but it has happened before. And a lot of people are aware of that. And you look at the psychological aspects behind it, and we're not quite there yet. We still have some positive seasonality that might carry us through this week. We also have quadruple witching that is going to be happening in Friday's session. That can really send a lot more volume into the market. It can produce some gyrations, or other times it's kind of a non-event, but we will typically see a pickup in volume. Just so you know, after I get done recording this video, probably during Friday's session, I will upload the 3 videos from the online course that I did Monday, Tuesday, and Wednesday. Feel free to check those out if you're interested in that and you were not able to actually attend the class. I have another recording that's already on the YouTube channel and Rumble channel where I taught the whole class 3 hours, and then I split it up into 3 different chunks. So either way you look at it is if you want to take advantage of that. And this is more timeless information. What I go through in the daily videos, that's based on right now, what's happening, where the courses that I teach and some of these additional online classes that I make available, you can watch them 6 months. Okay, here we go. You can watch them 6 months from now and it's still applicable. Where today's video that I'm doing here, that just applies to today. All right, let's go back and talk about what happened. Right at the open, we had a gap higher open at R2. That was at 44.93. We were still below that 4,500 level, which is more psychological. Prices then fell back to R1 at 44.80. Then we started to climb out of that. We got back above R2, but we did not reach R3. That was higher than the prices were achieved in Thursday's session. If we did get to R3, it would have been at 45.19 before closing slightly off of the high. So we were up 0.84%. Not a bad move, especially compared to what's been happening lately. Volume is above average. Now, some of that could be playing into this quadruple witching that's coming up, and the fact that folks are also coming into the end of the quarter. Now, that's going to develop more towards the latter part of September, but they might be starting to front run that a little bit now. Our technicals were mixed still. We're showing a lot of improvement in the short term, but we're not trending right now. So we're just pretty much treading at this point. And it's about inflation and interest rates. And I'll talk more about the economic reports that came out. And we're trying to figure out, are we shifting our scenario now? Because if we had stuck to the scenario that the market had been latched onto for the last few weeks, prices should have tanked in Thursday's session, but I'll cover that here in just a moment. Okay, some comments. The S&P closed above 4,500 and the NASDAQ was able to close back above its 50-day simple moving average. Those together are positive. The European Central Bank ended up raising rates, and they have different interest rates where they do this. But the positive takeaway was that there was a hint that they might be done raising rates. And the Bank of Japan and China, okay, let me back that up completely. The People's Bank of China, okay, I'm so used to saying Bank of Japan. They'll be cutting their rates 25 basis points, and that'll happen on the 15th of September. This is some of the economic weakness that's going on in China, and it's like, okay, well, what do we care about that? It's because a lot of S&P 500 companies do business in China. So they're trying to stimulate things there. Growth did underperform value. That's one negative sign that we took out of Thursday's session. They were both up, but growth did underperform. And right now, because we've been chopping sideways and we have a somewhat of a solid up day, the Stoke RSI, one of our short-term indicators, is already in extreme positive territory. And then this scenario where we had been working with the idea, this was more negative than positive, that we were seeing economic reports coming out stronger than expected, and that was pushing prices lower because it was getting more realistic that the Fed is going to have to keep rates higher for longer and possibly even raise rates. And then we were worried about what's going on in China, and oil was starting to rise. So that was producing more of a negative backdrop. But then up until about a week ago, we started seeing weaker than expected economic reports coming out. And actually, it was more towards the latter part of August that we saw a nice little bounce. That doesn't seem to be the pliable scenario for right now, but we don't really know what the new scenario is. So we're kind of shifting potentially over into something new. And that's what I do. I kind of go through and analyze things and try to figure out what's the pulse of the market and then develop, okay, is good news good news? Because that's what happened on Thursday, where typically good news has been bad news, suggesting that there's too much economic strength. And then the dollar was up and interest rates were up. This is something else that usually has been adding some headwinds to stock prices. Well, the fact that they were both up, it's like the stock market didn't even care. And the yield curves that we follow are still inverted and sentiment is still positive. It ticked up to 55 with the up day where it had been at 51. Our trend is positive, but both with the short and intermediate term ADX, we're still below 20 and they're still below their moving averages. However, the green line is on top for both time frames. So we would default to the positive. And I should have changed our bias over to positive. And this is one of the only subjective things that I come up with. I like to let the charts speak for themselves. I come up with the bias and momentum, and that's just kind of how I'm seeing things at any given time. Where I would still keep our momentum at mixed, even after having the up day, we're not trending. There's not a lot of conviction that's really going on right now. Okay, the economic reports that came out, we had the weekly jobless claims. They came in weaker than expected at 220,000. Last time it was at 226,000. They expected 226,000. Last week it was at 217,000. The continuing claims, not a lot different at 1.688 million. And I have charts to show you this. Then the PPI came out, and the market could have just cratered after this. The headline number was up 0.7%, much more than the 0.4% that they had expected, and up from the 0.3, more than double than what we saw the last time the report came out. And then the core PPI, which tends to be more important for really gauging things, it came in as expected. So that kind of kept the market sane, at least a little bit. And it was half of what we saw last time, where it was up 0.4. Retail sales came in, and I forgot to add that to the calendar. I even talked about it, and I knew it was coming out, but I didn't put it on the economic calendar. This could have cratered the market too. Whoa, we expected 0.2%, and it came in up 0.6%. And that's up from the 0.5% that we saw last month. But instead of this being negative, they took it more as positive, saying, okay, the economy is not falling apart. The consumer is still strong. Even though there's inflation out there, people are still out buying things anyway. If you take out autos, we were greater than the 0.4 that they had expected. We came in up 0.6%, a little bit down from the 0.7% that we saw last time. Business inventories were unchanged. They expected it to be up 0.1%. Last time it was down 0.1%. Okay, here's some charts, and I have to move this around because I can't see all of the chart you can't see this, but I see it when I'm recording this. The final demand PPI, where we have the total, that's the blue line, that's the headline number, where it's starting to go back up, where the core is continuing to decline. So the market could have fixated on whatever it wanted, something positive or negative. It chose to look more at the positive, at least on Thursday. Okay, now I need to advance. Then final demand PPI year over year, where the goods are still going up, where the services are leveling off and actually declining a little bit. And then we have our chart just showing the headline number, how it had been declining and now it's starting to go up on a year over year basis, and it's continuing to climb on a month over month basis. but we're still seeing a decline with the year-over-year basis with the core PPI, and we also declined on the month-over-month change. And then retail sales ticking back up slightly. They're still positive. And again, this could have been taken as negative, but no, it was taken as positive. And then month over month showing an increase over where we had been from last time. Weekly jobless claims ticking back up slightly, but what we follow the most here is the blue moving average, and they are continuing to decrease, suggesting that the labor market remains strong. And this can act as a leading indicator because these numbers will all get baked into the unemployment number and the employment situation report that comes out later on. And then the continuing claims also trailing off a little bit when we look at the 4-week moving average, suggesting that things aren't falling apart, at least yet. So when we take all of that together, we have the initial claims, which is the red, and they are continuing to go up slightly. And I'm just looking at the raw numbers here. I'm not looking at the moving average, where the continuing claims are declining slightly. And then at the beginning of the month, we received the unemployment rate, just to kind of put them all on a chart where we can see them at the same time. And then keeping an eye on this is some research put out by RenMac, where at what rate do interest rates really become a problem for stocks? According to their research, it's when we get over 4.02%. Currently, we're at 4.29%. So we're well above that, over 0.25% above of where they say problems should start arising. Here's the intraday chart where we gapped higher. We gapped above R1. We actually got up to R2 immediately, came back down to R1. We were able to bounce back up, get back above R2. We never made it up to R3. And then we did close down a little bit, but pretty much near the high. So looking at just the index itself, yeah, this was a pretty good day. Now let's go inside, and you can see the red line is above the blue line. That means that value outperformed growth. They were both up, but we want to see the blue line on top of the red line really outperforming, and that's not what happened. Looking at growth of value for the S&P 500, we were actually negative when we compare the two intraday. So that's another negative sign, suggesting that there's not a lot of strength behind the move that we saw. Then looking at a closing daily chart with closing values where the ratio did decline, we're chopping really sideways to the intermediate to short term, but longer term, we're still in an uptrend. But to have an up day like we saw and to see this ratio go down, that's a bit of a warning sign there. Keeping an eye on the VIX, the average from 1990 up to 2022, the blue line is going up. That would be negative for stocks if we play out the way that it has historically. Looking at the VIX, where we declined with the line chart and the bar chart, there's just not a lot of fear in the market these days. And looking at the volatility of the VIX, it's also decreasing. So just showing that we're not really moving all that much as far as emotion is concerned. But here, this is another thing to be a little bit concerned about. The 5-period simple moving average of the equity put call ratio, it's continuing to go up. That's negative. When we finally top out and we're in an extreme positive territory area right now, if we start to roll over, that could be when we get some support from this and help stocks to actually go higher. Then this is a longer term look at that same chart, showing how we're above the 0.8 level. And we don't really know where this is going to top out, but we're just waiting to see if that will happen. And then looking at the VIX to VVIX ratio, this is starting to go back down. So that is a little bit more positive, but we're still going up. When we look at the long-term 253-period simple moving average, we want to see this roll over and start to go down for it to be positive. It's still going up. We have the latest reading from the American Association of Individual Investors. They react to what's already happened typically. They're still positive, even though they declined slightly from where they were feeling a week ago. And we're watching this red moving average here showing that throughout the year, they have been improving with their sentiment. But we're not getting any kind of an extreme positive or negative reading right now. Looking at the advanced decline line, we turned up based on price and volume, and we're above the moving averages. This is a little bit of a concern. We saw a bit of a breakout with the new highs, a bit of a contraction with the new lows, but we're declining with our 5-period and also with our 10-period. The advanced decline ratio, with the update, we were able to cross back above zero. So this is slightly positive. Accumulation and distribution coming right up into the moving average now. If this continues to go up and eventually the red line turns back up, that would be much more positive. But we can't really read into that right now. The chicken money flow is turning positive. So we are seeing some improvement. And the previous chart, accumulation distribution and the chicken money flow, this is trying to measure what's the smart money doing, because that's what we want to be doing too. But the ratio between risk on and risk off, it was up a little bit, but it has been declining lately. That's more negative. And here's our trend where the ADX, it's turning up just a little bit, but still below its moving average. So we're not in a trend right now, but the green line is on top. So we would default to positive. And here's the short-term version, also turning up, but not crossing above the moving average and still below 20, but the green line is advancing. The daily chart, where we were finally able to get above and stay above the 50-day moving average and above this pivot level. Okay, can we stay up here now, or are we going to come fall back down below it? And then on the bottom, we're seeing that volume is picking up to above average. But be a little leery of that, because if you see the blue line here, which is the moving average, it has been declining throughout the summer months. The Stochc RSI starting to give us an extreme positive reading. That's a short-term indicator. Looking at the stochastics, not quite extreme in the short term. Remember, this is a subdivision of the short term. We're turning back up in the intermediate short term and also showing some improvement in the long short term. The force index looking more positive. So this is showing some improvement. And we're getting above the double and triple exponential moving averages based on 20 periods. But these two lines are still on top of each other. We want to start seeing a move up and then see these lines cross and actually have the green line go above the blue line. It's too early to tell if that's going to play out that way. Showing some improvement with our 50-period double and triple exponential moving average study. We had been underneath the red line, which is the triple, and we came back up to the double. The go-no-go system is turning back more positive, and this is kind of hard to see. You've got all these funky colors here. It's turning back to a lighter shade of blue, which is which is positive. All right, that's crazy. All right. And so, but we probably want to see some more follow through with this. But we are showing some improvement in this chart. The new highs, new lows, we're starting to break above the midpoint. Now, one thing to also keep an eye on is what is the highest high value line, which is the blue line? What's that doing? It's still going sideways. What's the lowest low value doing? It has been going sideways, showed a little bit of an improvement, but still chopping more or less sideways. Also suggesting that we're not trending right now. The TTM squeeze, it's still looking positive though, and it's kind of hung in there the whole time. The balance of power above the dashed line and showing some improvement. So that's turning more positive. The BPI, the bullish percent index for the S&P 500, it came almost down to 50 and showed just a little bit of a tick up. But we want to see this really bounce up for it to turn more positive. And we're crossing back above zero with the S&P 500 McClellan oscillator. So that's starting to turn the summation index up based on price, where we had already been turning up based on volume. And sometimes volume leads when we're looking at this chart. The top part and the bottom part, they're two completely different indicators. I just plot them together. Now, sometimes we're led astray when volume tends to lead, but other times this can give us a heads up that things are improving, or if we're turning down, that they're starting to turn more negative. The NYSE McClellan oscillator also crossed back above zero and is looking more positive. We're starting, it's really hard to see, but we're turning up just a little bit based on price and volume. Now, these two charts are calculated the same. They're different indicators. The S&P 500 one is actually a different study, but I just use this for a comparison, and then we look at this at a broad range compared to the S&P. The Elder Impulse system for the S&P has gone from neutral back to positive. The mass index, we're still wondering what kind of a signal is being generated here. We're not really clear about that. The PMO is chopping more or less sideways, seeing a little bit of an improvement based on price. We're turning up just a little bit, but also kind of looking negative based on volume. The PMO study, when we look at all of the stocks inside the S&P, well, the PMOs that are rising, that continues to go up. We're seeing a bit of an improvement with the buy signals, and we're turning back up with the PMOs that are above zero. This is also more positive, the Swenlin trading oscillator. It had been turning up for the last few days, but we were still below zero. Now we've crossed above zero based on price and volume, but we just barely ticked up with the NYSE bullish percent index, and we're still below 50. That's negative. But when we look at the NASDAQ 100 BPI, turning up and above 50, showing some improvement. We're still inside the Ichimoku cloud. If we continue to go up from here, we might have a shot at actually breaking out of the cloud. If we come down, we're still wondering if this whole green area is going to provide support. Our oscillators are still mixed. The slope is still positive, where the TSI is turning up a little bit, but going sideways. Where the MACD is negative, we're sideways with the PMO, we're sideways with the PPO. A little bit of an improvement with the tricks and turning over a little bit, but still positive with the KST. These are our longer term oscillators. So we're still seeing a mixed picture here. Looking at our moving average tree, we're above all of the plotted moving averages, and we're breaking out above the 20 periods and the 50 period moving averages that we follow. That's always an improvement. Can we stay above it? If we start to go back down, will one of these moving averages provide support? The Bollinger Bands, where we had been just slightly above the midpoint, showing a little bit more of an improvement here. Also getting above the midpoint and getting up to the top range of the 1 standard deviation, but these lines are still pretty much going sideways. We're actually seeing a contraction here, which is also confirming that we have not been trending. The 20 period simple moving average of the open, high, low, close, also confirming that we've been going sideways as we try to go back up above this little mini rainbow. But the parabolic SAR system, it has not turned positive yet. The dots are still on top. If we get some more follow through and a dot comes underneath, that would really help things quite a bit. Chaikin oscillator getting above the midpoint and showing some improvement and barely turning positive. The money flow index, which had dropped below 50, has now climbed back above it. So that's showing some improvement. The ultimate oscillator also was below the midpoint or below 50. It's crossing back above. That's showing some improvement. The RSI, which were with both the 14 and the 9, we were camped out at the 50 level, starting to turn back up. So that's showing some improvement. The MACD, longer term on a weekly chart, is still negative. The Heikin Ashi looking more positive with an open candle. The Kegi chart, which had been positive, remains positive. The Renko added another open box here. That's turning more positive. And the 3-line break, it hasn't redrawn, but it had remained negative while we've been chopping around. The equal weight, still underperforming the S&P 500, but did show some improvement. And we're seeing a bit of a tick down in the ratio, but overall, the big stocks continue to outperform the rest of the market. The Dow, this is encouraging. We were able to get above the pivot level, above the 50-day moving average. Can we build on that, or are we going to immediately come right back down? Where the Elder Impulse system had been negative, it now switched to positive for the diamonds. And we're above this previous high, this red line. And if you want, go back and look at some of the other videos. This red line was on here when we were coming up to this level, even before that. So I drew that on here, and that just shows that this has been pretty significant, pretty much going back to early spring. Well, we're above this level now. Can we build on that? We're above the 50-day moving average. Can we build on that? The Qs were neutral, and they've switched back to positive. With the momentum oscillator, we're pretty much going sideways with the PPO, with the NASDAQ 100. But the fact that we're still above the moving average and above zero is showing some improvement. The NASDAQ also was able to get back above its 50-day moving average. Can it stay there? And we're above the 61.8% retracement level. We've been slicing through this up and down pretty quickly lately. So it's not as significant with this Fibonacci level. The FANG index, which has been hanging in there, still above its 50-day moving average, still in a longer-term uptrend. The small caps, which you'll see on the next chart, came down to the support level, which was just about the 200-day moving average on the Russell 2000 index. We're bouncing back up, but now we're starting to bump into the 200-day moving average on this chart. Where on this chart, we came down, and 3 times we've hit the 200-day moving average with the Russell 2000. We're showing some improvement with the RSI, but still below 50. We're still working off of a recent golden cross. The MACD rolling up a little bit, but it's still negative. This is kind of significant. We want to be watching this level to see if the 200-day moving average for the Russell 2000 can hold if we start to go back down. The small caps for the Elder Impulse system, they had been negative for quite a while. They're switching back to positive. The ratio between small caps and the S&P still are underperforming, even though it ticked up slightly. The mid caps didn't quite come down to their 200-day moving average, pretty much chopping sideways right now, but not necessarily falling apart, where we switch back over to positive for the Elder Impulse system for the mid caps. Well, when we look at mid cap growth versus value, it really underperformed, even though longer term, it's still in an uptrend. And then Dow theory, we turned up with the Dow. We're turning back up slightly, but we had done some damage here with the transports, where the utilities are continuing to show a little bit more strength, which could be negative for the S&P. And when we look at the ratio between the transports and the S&P, turning back up slightly, but the transports are continuing to underperform. And then looking at the Dow versus the transports, we came down slightly with this ratio, but we want to see this really headed down for it to be more positive. And yields ended up going up in Thursday's session on the 10-year. And then looking at Tom Bowley's research, we're still in the middle part of September, where his research has suggested that we go through a positive period. But please beware, during the latter part of September, we tend to come into a weaker time. So what's our outlook for Friday? Still dealing with earnings reports as they're coming out. It will be quadruple witching. Quadruple, that's good. Now, there's some news things that are kind of lingering in the background, and I just want to make you aware of these. We don't know if this is going to have any kind of an impact on the market or not. It might have a more economic impact that ultimately could feed over to the S&P. But at the time I record this, I don't know the current status. Is the United Auto Workers, are they going on strike? If that gets resolved, is that really going to help things? If they go on strike, what's that going to do to things? There's also lingering coming up very soon, the potential of a government shutdown. It's a whole political game that is being played. Please, if you're following this, try to find out what the real facts are instead of the gamemanship that's really going on through this whole process. What you're hearing in the media is not really reflective of what's actually going on. That's all I'm going to say about that. And then the whole student loan, where it looked like they weren't going to have to resume making their payments, that's going to start to kick back into gear too. And folks that are building their careers and hopefully making some decent money, well, that money was going out to buy stocks and to do retail and maybe to travel. Well, now that's going to have to go back to repaying loans. So that might also have an impact. So we just want to be aware of these things. The technicals are improving, but we're still not trending. We will get import and export prices on Friday, the Empire State Manufacturing. To me, this is the important one, industrial production. And then in conjunction with that will be capacity utilization. Consumer sentiment is also pretty important. And then keeping an eye on all of the geopolitical events that are happening. Here's the calendar showing what will be coming out on Friday. We're also starting to look ahead into next week. We're dealing with options expiration right now, and we're up more than we're down. But next week, we're down a lot more than we're up, and that's kind of feeding into this negative seasonality that we may be coming into. However, when you look at September 15th, the Dow is pretty positive, where we're neutral to positive with the S&P, but we're negative for the NASDAQ. Now, how's that for across-the-board confirmation? All right, we will be on the 10th trading day of the month, where we sometimes during a pre-election year see some weakness during this time. And then we'll be on the 15th calendar day of the month, where we tend to see some strength. Isn't that interesting? Now, this chart takes all the years from 1950 up to 2022, where the previous chart is just looking at the pre-election years. And we follow the green dashed line. That's the S&P. And then looking at a longer term version of that chart, here's the NASDAQ. Are we coming up into this solid point now before we see some weakness? Not saying it's going to play out that way. That's just the way it has played out before. The S&P also topping out at some point and then starting to show some weakness historically as we enter the latter part of September. And then when you look at all of the pre-election years going back to 1950, we're only up 33 1/3% of the time. The scenarios, not going with the down one, not going with the up one because we're not trending, still focusing more on that sideways trend. The warning signs. And I'll show these in the weekend videos that I do. The longer term trend signals, we're still below those weekly charts that are showing the trend lines where we haven't been able to break above those. Seasonally and historically, September tends to be weak, and we're coming up to what might be the end of a positive streak in the month of September. The equity put call ratio is still going up. The longer term equity put call ratio is also going up. The risk on, risk off ratio is still not really convincing us that we're looking more positive. The cumulative new highs, new lows for the NASDAQ are still showing weakness. We're still above the yield where we were at back in 2007. We're watching to see if that's going to roll over at some point, and will that be giving us a warning if that happens? The parabolic SAR is still negative, and we're dealing with earnings season. The positive side, and I'll also deal with these in the weekend videos, we do have seasonality and setups that are in the background. The daily special K chart is positive. The weekly chart is negative. We're still above the downtrend channel upper line, and I'll show that over the weekend as well. We're still mixed with the S&P 500 oscillators, where we're still positive with the NASDAQ 100 oscillator, but it's going sideways. However, it is above zero. The S&P is still outperforming utilities, and the Staples to S&P 500 ratio is declining. The Russell small caps and mid caps still have recent golden crosses. Small and mid cap growth have pretty much been going sideways, but they're still positive. The financial sector also working off of a recent golden cross. The Coppet curve, now a few weeks ago, generated a buy signal. So what's our conclusion? We're improving, but we're not trending now. We are turning more positive in the short term, especially if we see more follow through in Friday's session, but we're not trending. Intermediate term, we're mixed, but showing some improvement, but we're not trending. We're still positive in the long term. So thank you. Sorry about my flubs and bubs and mixed up words. I don't edit this. I just hit the button and start going. So I hope you have a really good day. I will be preparing the videos over the weekend, and I will talk to you in the next videos.